Hi everyone, my name is John McMillian. I serve as one of the directors in our Revenue Cycle division, specifically working as a marketer on Payment Integrity Compass. And what I'd like to do today is take you through what is a typical meeting, running through both the deck that we use to open a session with a member, but also the demonstration portion of Payment Integrity Compass up into where we would close it. Obviously, I am in a room by myself, so there's not going to be the interactive discussion that you would normally have with a member, and it will be somewhat generic in general because I don't have a way of customizing it to a specific situation, but I think this will still serve as a great example of how you would typically conduct a Payment Integrity Compass meeting. So I'm going to start with our research deck. If you're new to the advisory board or if you've sold other products, you know you're probably going through the orientation at this point that research is at the core of everything we do at the advisory board. It drives our decisions and really is what is the centerpiece of what our engagements are based around. So I want to start there for a moment, and I always like to do this with any member. Obviously, there's usually a round of introductions. And at that point, we start to maybe have a little bit of context for why the meeting is. I give an opportunity, let's say, for the CFO to set the stage before I jump in, but we'll assume we've already dispatched with that part of the meeting, and we'll jump into the deck itself. So looking at maximizing contract value, really our team's been focused on how do we, at the advisory board, help organizations really address all of the growing complexity of contracts. How has healthcare reform impacted finance and revenue cycle? And what we've seen is there are no shortage of challenges facing healthcare executives just trying to preserve the financial health of their institution. And what's become very obvious to us as we've partnered with a lot of progressive organizations like UPMC, Cleveland Clinic, other organizations like HCA, is that most healthcare institutions are faced with replacing their existing process, technology, and adding additional resources to successfully eliminate revenue leakage and maximize contract yield. So what I want to do now is just spend maybe 10 minutes going through what we see as a national landscape, a lot of the trends that are increasingly making this goal of eliminating revenue leakage more and more difficult. So before I start, I always like to go through really where we come from. And this is our revenue cycle division. We have a lot of engagements that we've partnered with organizations to grow our expertise in the world of revenue cycle, from front end to back end, and even including mid-cycle. But what we like to feel, or say rather, is Payment Integrity Compass is really the centerpiece of what drives all of our revenue cycle engagements. And although a lot of people would consider this a back-end partnership, the reality is when we sign that contract with the payer, it really kicks off the entire revenue cycle. So we'll go through why this space is so important in the next coming slides. So moving into the research, this is really the way we've captured the national landscape, and a lot of the themes that we see are influencing the growing complexity of contracts. I don't think anything's going to be that surprising to anyone in the room, but I think it's still important to go through to ground us for why we're here. So first and foremost, we've seen a lot of states shifting to the new APR-DRG methodology. This makes those organizations that much more difficult in accurately calculating their expected reimbursement. We also know that there's going to be a transition to ICD-10, and when that happens, we're expecting denials to double, if not triple. Now, when it comes to government payers, we've seen continued rate cuts. That's nothing new, nor is it going anywhere. So it makes getting our margins that much more important, getting them right in the commercial payer world. And then when you start to layer in new world of complexity like value-based agreements, it's just adding fuel to the fire. So what I would normally do in a meeting at this point is stop for just a moment and ask, is this the way that you see the world? It usually takes a couple minutes of discussion, gives me some information about the way that they're seeing things, and we can move on from there. So moving into the next phase of this, is what I really want to highlight is where we see reimbursement trends going from the next 3 to 5 years. So if we're looking at the slide, the top line here that I'm highlighting is our expected reimbursement. The bottom line is the actual reimbursement, and unfortunately the gap in between is what we refer to as revenue leakage. Now, even as organizations start to increase their portfolio to get more progressive and involve more value-based contracts, and you can see up to 40% of their overall contract portfolio, we still expect the majority of revenue leakage to be coming from the majority of your contracted revenue, which is fee-for-service. And although there's a lot of factors over to the right here that are contributing to why there is revenue leakage, there's one central theme that we see consistent across every organization we've ever worked with, and that's there's some inability to accurately calculate all of the rate schedules across all of your payers. That could be because of the APR-DRG methodology we mentioned before, or because there's more complex terms like stop-loss or carve-out language that their current systems aren't able to compute. Or there's no contract management solution on the physician side and only on the hospital side. Whatever the reason is, we're finding that there's a portion of their contracted revenue they just don't have visibility into. So for us, top-tier revenue management is going to rely on locking down the fee-for-service revenue leakage as it exists today, while strategically preparing for the new world of contracts. So I'd like to stop here for a moment and just make sure that's the way that you see the world. So obviously stop there for a moment, get their feedback, and can move on. There's always things I like to try to get in the pre-wire. I like to try to get an understanding of their commercial payer mix versus their government payers, and if I haven't been able to do that before, this to me is a great opportunity to do that. So moving on, I want to kind of breathe some life into what we've been going on a national landscape to a specific scenario with a case study with an organization that I feel is very relevant to a lot of the themes we just discussed. Although this organization is slightly different, there are 3 hospital systems in the Northeast, the themes are consistent with every organization we've ever worked with. So let me get into this. So this is an organization that really wasn't doing much in the way of collecting payment variances and addressing their revenue leakage. You can see that in the highlighting here that they only had a baseline collections of roughly $150,000. That's pretty bad. They were doing the bare minimum. They recognized that there was an area for improvement here and that there was revenue to be captured. So what they did is they actually invested in a contract management tool in order to take more revenue in that they know they were losing. And what we saw in the first year is that they had about an increase of $850,000. In year 2, they took in just under $1 million. But given the size of this organization, they should have been collecting nearly $3 million per year. They were missing the mark significantly. And there's really 3 key issues below that we've captured for why that is. The first issue relates to this theme we were talking about in the former slide, and that's that they did not have visibility into 35% of their payer volumes. In this situation, because they were in the Northeast, they were one of the states that had that APR-DRG methodology that they struggled to be able to calculate their expected reimbursement on. They also did not have a solution on the physician side, and we all know in the professional world, it's a high volume of small dollar variances that add up over the life of the contract. So the issue there was they really didn't have a good idea of the type of variances that were occurring, and moreover, didn't have a means to go after them. I'm going to skip over the second point because I want to focus more on the contract management tool they invested in. The third aspect here on the very right is that the solution they invested in did not have business intelligence rules to get smarter with time. What I mean by that is that any time a variance hit the system, it was treated as if it was the first time the organization had seen it. And as we all know, organizations have expertise in identifying some of the systemic trends they're experiencing with their payers. We want to have our organizations empowered with a contract management tool that will allow them to identify these trends so they don't have to diagnose them again in the future should they occur. And then going back to the middle part, this was a little bit outside of the contract management tool they invested in, and really was that they didn't have the level of detailed reporting they needed to make the right decisions from a clinical and financial perspective. What was happening is what we refer to as unforeseen demand destruction. What we mean by that is every organization we've ever partnered with is making some sort of quality care improvement. They're doing things like reducing readmissions, and in a fee-for-service world, that means they're taking away services they would have otherwise been reimbursed for. It's this new form of revenue leakage. The key here is that you're empowered with enough details and data and a flexible reporting tool within your contract management system so that you can align the clinical decisions with the financial ones. So all of these factors contributed to the fact that they were significantly missing the true opportunity. And I just wanted to pull up here for a moment and see if any of this was relevant to the situations you're dealing with or kind of hit close to home with some of the challenges you may have. This to me is one of the most powerful slides in the deck. If I'm running out of time or feel that I have to customize things, I usually always leave some aspect of this in because I think this is what fosters the discussion of what their true issues are. Obviously the goal in the pre-wire is to uncover as much as we can of the type of tools they have, where they're focusing on what they think their issues are. But at the end of the day, this is where you've got everyone in one room that can agree on some of the significant challenges that can really help you customize the demo that we're about to go through to make sure it's relevant to their scenarios and their needs. So moving through, what I want to do now is actually use this slide as a way to set the stage for the demonstration we're about to go through. So this is nothing more than an illustration of what we refer to as Payment Integrity Compass. Now, I'll kind of break this down in parts. The left is all of the data that's flowing through the tool. Now, I'm going to talk about that in a little bit, so we'll put that aside for the moment. When we go into the demonstration, I'll be talking about the detailed data feeds in just a moment. But I really want to focus our discussion for this slide on the middle column, and that's because this breaks down in kind of an easy format all of the different areas of functionality of the partnership. This is one fully seamless automated solution, and it does cover a lot. We like to call this a cradle-to-grave contract management system. So as a result, I want to just make sure that we have a 20,000-foot view of everything we'll be covering, since there is so much ground to cover today. So really it starts first and foremost with a best-in-class calculation engine. And what I mean by that is our system's able to calculate any unique payer methodology regardless of the complexity across both government and commercial for hospital and physician. If you were to speak to some of our partners like UPMC or Cleveland Clinic, they would tell you one of the central reasons they selected us as their partner is that we can handle any unique payer methodology they have, but moreover, our calculations engine is flexible enough to address new unique payer methodologies and more complex contracts as they're introduced to the market. The second piece is that we're able to unify unique data sources across an entire health system. If you think about some of our larger members like Providence Health System or LifePoint Hospitals or CHE Trinities that have multiple hospitals, they're all on different patient accounting systems, different practice management systems, sometimes have different sources for their claim data as well as their remit data. So what we can do is act as a funnel to bridge all of that information into one platform so we can truly provide the organization with one source of truth. We feel this is vital in identifying the systemic trends, but also being able to reverse them. The next piece is integrating a fully automated workflow solution tool in the same system. As I mentioned before, this is one seamless platform. These are not separate technologies. So what we've done is automated the workflow collection tool for underpayments and denial management. We've incorporated robust business intelligence rules that allow the system to get smarter with time, and we've also incorporated batch appeals technology that allow our members to group hundreds, if not thousands of claims together as one, so that our cost to collect doesn't go up and we can truly go after every dollar owed to the organization. Stopping here for just a moment, this is where the most black and white ROI of the system exists. And the reason I say that is every organization we've ever worked with has some sort of payment variance threshold amount. For example, a larger organization might say, we don't touch any underpayment or denials under $1,000. Small organizations, I usually hear that amount's $300 or $250. But at some point, an organization doesn't have the bandwidth to go after all of the dollars being lost, and they simply write it off. We want to have a $0 tolerance for revenue leakage, and this is how we accomplish that. And we'll be going through some examples that illustrate that as well. The next piece is we've integrated a fully flexible and custom report writer into the tool. Because we're taking in such a rich and broad data set, we want to enable our members, or moreover empower them, to be able to run any level of detailed reports that they need for financial analysis, payer performance analysis, or even keying in on individual payment variance trends. We feel this is vital in the process, and that's why we incorporated it in the solution. And then the final two buckets really address the modeling portion of the tool. We feel it's vital that the same system that you're building your contracts in for active expected payment calculations has to be the same system that you're modeling in, because if you model in one place and build contracts in another, inevitably there will be a loss of interpretation. So what we do is provide the same sophisticated calculation engine where you're building your contracts. It's the same robust feature and calculation engine where you're modeling. And the great advantage here that we'll go through an example in just a moment is as you're modeling and you reach that last iteration of the proposal negotiation and you agree on that last term that you've modeled, all you do is simply flip a switch and that becomes your active contracts in your system. Organically over time, you're not reinventing the wheel and building new contracts. They're already built in the system because you've been modeling them with the payer. So all of this creates what we call Payment Integrity Compass. It actually came to the advisor board via an acquisition in 2010, a company named Concuity that you may have heard of. started in the early 2000s in the Bay Area of California. Since then, we've made significant enhancements to the technology to address the rapid change in healthcare, but we've also incorporated a very robust partnership model that we have with all of our memberships at the advisory board to ensure that it's successful. We feel it's vital that true success is gained at the intersection of technology, people, and process, and that technology alone cannot help you reach your goals. So we'll talk a little bit more about the partnership aspect as we go through the demonstration. So before I move forward, are there any questions from the group on Payment Integrity Compass itself? I always like to stop there, not only just to catch my breath, but I also think it's important to pause consistently throughout the discussion, or else it feels more like a speech, not a discussion. But also you'll find that people are starting to find interest in particular areas of the solution. They'll focus on that, and it kind of helps you understand where you want to go throughout the demonstration. So what we're going to do now is switch gears and jump into the solution itself, which is the fun part of today. And I'm going to start by explaining the data feeds that are integral in populating the solution to get to this point. So we've logged into Payment Integrity Compass, but to get to this point, there's some few key data sets that we've incorporated. First and foremost, we have a detailed patient accounting system data feed coming from your source system. That could be Epic, Cerner, McKesson, Meditech, or whatever it may be. There's a lot of reasons we want that rich data set, but one of the core reasons is that we are going to calculate your expected reimbursement off of your charge detail. But that's what you're doing today, and we feel that creates what we call false positives, because we spend time analyzing were we actually not paid correctly, or did the clearinghouse third-party scrubber make this change to the claim before it went to the payer, and that's why we think there's a variance. So in order to eliminate the false noise in your system, what we do is we supplement the charge detail expected payment calculation with the scrubbed 837 claim that goes to the payer. So what makes us unique is we will calculate every single account twice. Once on the charge detail coming from your patient accounting system, and then a second time on the scrubbed 837 claim, allow you to reconcile the delta between the two, and then empower our members with the flexibility down to the rate schedule level to determine which is your source of truth. The majority of your contracted revenue will most likely be calculated on the scrubbed 837 claim. It makes sense, it's more accurate. But in some scenarios, because you have complex stop-loss or carve-out language, you may want to set the contract up on the charge detail. What's important is that you have the flexibility to make that decision. So the next piece of data feed we take in is the 835 electronic remit. And we do that for two primary reasons. First, we want to tease out patient responsibility, so we're looking at a true payer variance. And second, we want to standardize all those non-standard denial codes across payers that drive us a little crazy. And what we do is we create conditional mapping logic behind the scenes that allow us to take whatever code the payer is using and roll those up into meaningful denial categories for your organization. We'll go through an example for denial management that will bring that to life, but that's an important piece of the data that we bring in. The next piece is that we are going to store and interpret and load all of your contracts in the calculation engine and cross-reference all the data I just went through to determine whether we were paid correctly, overpaid, underpaid, or denied. And based on those categories, we'll triage the accounts with the business intelligence rules to the appropriate collection specialist. So let's start there. So we've logged into the solution through the eyes of one of our collection specialists. You can see here we're somewhat of a generalist, and what I mean by that is we have a variety of underpayments and denials. But this can be customized to meet your business process. And what I mean by that is that you may have teams that are only dedicated to denials, or teams that are only dedicated to underpayments, or maybe specific to certain payers. You'll create the business intelligence rules, and I'll show you how to do that in a moment, that will dictate how the accounts are triaged to the appropriate collection specialist and how you want to manage your underpayment and denial management teams. So I think the best way to start this off is actually picking on an example of one of these new accounts, and we're going to use this Estelle Fields underpayment scenario to start to bring life to this system. So as you can see here, we know there's an underpayment because the status of the account's been automated by the system to tell us so. There's no human intervention needed here. Had it been a denial, there would have been a code on the 835 and we would know the specific type of denial that we're dealing with. Since there's an amount due and no denial code on the 835, we now know it's an underpayment. Now the reason field that's under the status is actually going to be blank if it's the first time we're looking at this issue. This is a demo environment we're in. I've gone through this example before, so that's why you see it filled out. But if it's the first time we're looking at this account, we don't know why we weren't paid correctly. The same is true for the project field. It hasn't been assigned to an appeal project yet, therefore this bucket would be blank as well. But it's been filled out because I've gone through the example. But I'm going to show you in a moment how you would populate both of those fields. But it always defaults to our calculation tab. And this is where we calculate our expected reimbursement amount of $31.65 versus our actual payment amount of $21.80. Had there been patient responsibility, it would have been captured here. And the difference between our calculated amount and actual amount equals the amount due of $9.85. Now, the description of how we calculated the account is just a little bit further below, and I always like to start my analysis here. You can see that we have two services rendered on this account. One is an ASC Group 1 at a rate of $9.85, and the other is outpatient services at 60% yielding $21.80. It does not take a rocket scientist here to figure out that $9.85 for the ASC Group 1 equals the amount due of $9.85, so that's what was not paid. But we still don't know specifically maybe why or how big this issue is. This could have been an isolated event, or maybe this has happened hundreds of times in the system. So what we want to do is drill down into the calculation detail a little bit further to see if we can get some more granular details here that we can run a business intelligence rule to find out how many of these accounts exist in the system. So you can see the two services rendered here are other outpatient services and the ASC Group 1. We calculated other outpatient services at percent of bill charged and ASC Group 1 on the ASC schedule. So drilling into the ASC Group 1 service, we can see that the CPT code or procedure code that's driving this is 64614. Now we can use that information to get very specific on the type of criteria we want to run to find out how big the issue is. So what I'm going to do is switch gears here and go into the admin section of the tool. This is a very noisy page. There's a lot you can do here. You can do things like restricting security access to building patient populations for modeling purposes, making charge master adjustments, but what I want to focus on for now is the recovery administration section. This is where we're going to leverage what we refer to as our assignment rules, or also known as our business intelligence rules, to determine how many of accounts exist in the system with this same issue. So I've already preloaded this for the sake of time, but basically I've clicked into this intelligence rule, and what we're looking for here is the below criteria. So we want to find any account in the system that has a calculation detailed description of ASC Group 1, payer name is Cigna, the amount due is $9.85, rev code of 360, the CPT code we identified of 64614, and the account total charges greater than $8,000. Now, one of my cheesy jokes I like to say in the meeting is if you can shop online, you can easily build a business intelligence rule. And what I mean by that is it's very user-friendly. So I'll show you how that's done. To populate that bottom line of the criteria, you simply click your selection criteria of account total charges, your logical operator of greater than, and key in the text 1,000, and simply click add, and that's how you populate the bottom line. Organizations no longer have to rely on their IT or IS teams to run the type of SQL queries that they need the expertise for. They now can, the end user is empowered to run the types of business intelligence rules they need to identify the systemic trends in their system. Now the next step in the process is we're going to tell the system what to do with these accounts once we find them, and that's the action tab. So what we're going to tell the system to do anytime it finds an account is we want to put it in a Cigna ASC project. That's what we're going to call this appeal project. We're going to have a status as initial payer review. We're going to call the reason for this underpayment as an ASC grouper issue. And we're going to assign this to Braden Decker. He's our collection specialist that works specifically with Cigna, and we know he'll be able to resolve it. Now you'd go out, you'd run this once, you'd see how many accounts are in the system. But if you're anything like me, you're not going to trust Cigna to fix this overnight. It's probably going to take them 6 to 12 months to update their system. So what you do is you come back here and you switch this from manual to automatic. And what that means is that forevermore in the future, whether an account comes in 10 days from now or even 10 years from now that has this criteria, it's not going to show up in your new work queue for a collection specialist. It's going to be tagged with a specific reason it wasn't paid, and it's going to be automatically routed to an appeal project So we spend less time re-diagnosing issues we've already identified and more time driving dollars back through the door. This is what can really make the ROI powerful for organizations that don't have this type of sophistication today. So I'll stop there for a moment and see if there's any questions from the group. One of the reasons I like to stop here is, number one, catch my breath, and number two, I feel like I've been talking for a while. I really don't want to feel like I'm preaching. I want to engage them in the discussion. You'll find a lot of organizations are pretty proactive. You start to show things, they're going to ooh or ah, make comments, they'll give you signals to whether they think that's good or not, and sometimes they'll interject with specific questions or comments of their own. So let's move to the next portion of this, assuming we've addressed all questions, and continue the appeal process. So in order to do that, I'm going to jump back to the account section of the tool. This is kind of your home screen. And we're going to leverage the My Projects field to actually look up the business intelligence rule we just ran. And you can see we've only got 3 projects here. Would this be a real environment with a member? You'd hopefully see a lot more than that. But in this example, we see that the Cigna ASC projects come back with about 8 accounts, just under $8,000. So we're going to click into that to actually start the appeal process. And the way to leverage this solution is you're going to click Select All to highlight all of the accounts and use the Correspondence tab to initiate the appeal process. So what we've done behind the scenes is we have loaded all of the non-standard dispute forms across payers. So Cigna has one, Blue Cross and United have their own, and we've auto-populated and mapped all of the information that needs to be filled out in those forms. This project's only 8, but think if this had been 80 or 800, we don't want organizations spending time manually filling out those forms. That's why organizations have payment thresholds. That's why they give up and write off anything that's under a certain amount, because they simply don't have the bandwidth to pursue projects of that size. So in this example, we'll use kind of a generic insurance appeal template. You can customize your greeting to the payer, description of the issue, and since this isn't actually going anyone, we'll be a tough guy here and tell them what we want them to do with it. Now, what you can also do is automatically attach the 837 scrubbed claim as well as the 835 electronic remit as part of the appeal project. It drives us a little crazy, the payers request to send us the 835. They sent it to us originally, so why should we have to send it back? But it's part of the game they play, so we've given our members the ability to do so. Now, you can fax, email it, or print it, but I'll just show you what the print version looks like. And if you look here, we just have an electronic control sheet of all of the accounts in the project, our customized greeting and closing statement, and then all of the individual forms filled out below. So you can see one for Jana here, second one for Kim, third one for Gilberto. Obviously, you get the idea. All of these forms have been filled out and ready to send to the payer. But we also give you the opportunity to actually edit and put in additional information in certain fields, for example, description of dispute. You may want to copy and paste language from the contract or add additional color that you think will help the appeal process, so we give you that ability. Obviously, the value here is pretty transparent. We've worked very hard to automate this part of the process, but what's interesting is we constantly have discussions with members and ask them how they're using this piece of the technology. Over time, inevitably, they tell us they're not using it anymore. That crushes us a little bit. A lot of work went into it. So we start to feel out why that is. And what they tell us is, once the payer recognizes that you have the ability to automate 500, 600, 1,000 claim forms and send it to them immediately, they back off asking for those forms, because it initiates a process on their end that they have to account for every individual form that they don't want to deal with. So what they'll do is start to have a better dynamic with you and work off Excel. I'm sure some of your payers work off Excel today. What we want to do is increase a better relationship so that can become more standard and use that technology to automate the appeal package should you need to. So in order to highlight that, I'll move back to the appeal project. And whenever you see export in our system, that means you take whatever layout of the data you're looking at and move it into an Excel spreadsheet. So just showing you what that looks like. If it would do it for me, it's taking a little time here. There we go. So you take the layout of information, you put it into an Excel spreadsheet, you populate it, clean it up, add additional language, send it off to the payer. Now we all know that Cigna requires a different layout of information for their Excel spreadsheets than Blue Cross may. So what we've done is in the report section of our tool that we're going to highlight in just a moment, but that I'm highlighting here, we'll actually load all of the different layouts of appeal packages that the different payers request. They're preloaded ahead of time, and all you do is populate them with the specific payment variance trend you're analyzing so that you can export it and send it immediately to the payer. So a few other things I want to highlight before we move on, one of which is this status column. And the reason I want to call this out is that this is dynamic. And what I mean by that is that as payments start to come back through the system, you'd like to come in maybe 30 days from now and see that all 8 of these accounts have been closed and paid correctly. This is automated by the technology itself. There's no human intervention. You don't need to go in here and manually adjust anything. The system will do that as payments come in. Now there's 2 ways you can account for it. You can have the system automatically delete them from the project once they've been paid correctly, or as I find a lot of our members like to do, is they have the gratification of coming in, seeing it's been paid, and manually deleting it themselves. It's totally up to you. The other feature I want to highlight is bulk modify. Bulk modify is where you can do something once and have it reflect on every account in the project. So there's a lot of things you can do here. You can change the owner of the project to say, you know what, Braden Decker's a little bit overwhelmed, let's move this project to John. You can change the status of the project because maybe it's beyond initial payer review. You can even change the reason code. So for example, you don't think it's an ASC group schedule issue, you think it's something else driving the underpayment, you can change that here. But one of the best practices we advocate with our members is adding a note detail here. So the activity type is a note, and you can say we've heard back from payer will pay soon. If I could type correctly. Obviously you want to add more details than that, but the point is you want to capture the relationship with the payer, what's happening in the process, and save that note. What will happen is all 8 accounts, that note will post on all 8 accounts, and then on a nightly basis we'll pass back what we call a notes file into the source system where all of the user-generated activity here will be captured in your patient accounting system. We do that because we don't want organizations having to duplicate efforts, and we want anybody in your patient accounting system to have the visibility of the work being done in this system. The other file I mentioned we'll pass back is what we call a contractual allowance file, or a CA file. And what that does is help you net down your AR at time of billing. So those are the 2 standard files that we typically send back for our members, but there's other custom outbound files that we can always be open to sending back should there be a need. So what I want to do is kind of finish out this example with how we close a feedback loop in an organization. And the way that we do that is leveraging the contracts tab. Think of the contracts tab as your electronic filing cabinet for all of your contracts. It's not where you actually store the contracts yourselves. We'll go in a moment to the calculation engine where you actually build and interpret the contracts themselves. So what I'm going to do is use a recently viewed contract, which is our Cigna facility agreement. And you can see that we've pulled out all the critical information for this agreement. So we've captured things like the contracted payers, the number of providers that are linked to this set of terms, all of the key rate schedules here. We've also have all the key dates like renegotiation dates or renewal dates. And we even have a workflow portion of the tool. There's other things like the legal description here. So there may be things like timely filing. Maybe you don't want to go through the big binder of the contract, but you just want to see, timely filing is 45 days. The other thing we've done is we've attached all the relevant documents. So, for example, we actually have the full contract itself loaded in the system. This is just a PDF image of the contract, but maybe you can get rid of those big binders, and you can actually go and do a quick term search of all, and things like coordination benefit language, copy paste it, put it in the appeal package. So the next piece of this is the ASC schedule. So what we've done is we've attached all of anything relevant to the contract. So if, let's say, the payer sends you the ASC group schedule, you can attach it here. But what I really wanted to leverage was the notes feature. And this is where you can add a note that really captures the relationship with the payer and immortalizes the systemic trends that you're working on. So in this example, we have failed to update ASC grouper. It's an administration error. There's 8 claims, nearly 8K. What this does is closes the feedback loop in an organization so that managed care now has a running list of all the issues the revenue cycle teams have been working on. It's hard for me to remember where I was last week, let alone an organization remember what the type of issues they were dealing with 6 months ago. And this is how you can close the feedback loop at the institution with all of the issues you're dealing with on a specific contract. So I'll stop there. That was really the full example I wanted to share, and I'll pull up now and see if there's any questions for the group. Okay, well, now that we've gone through the underpayment example, what I'd like to do is transition to a denial management example, since that world's a little bit different. But we really look at underpayment and denials as two sides of the same coin. The difference is with denials, we actually know why we weren't paid, where underpayments, we actually don't know why they didn't pay us correctly. So let's move to that denial example. We're going to pick on Lee Dean as the account that we'll look into here. And we know it's a denial before any human intervention here, because on the 835 there was a specific line item denial code that told us it was a denial. And whatever code that payer was using, we map that to denied services not covered. And we'll go through that process in just a moment. We can see there's an amount due of $600, but we don't know if that was the full denial amount or if there's an underpayment and denial scenario going on here, so we need to look into this a little bit more. I always like to start, as I mentioned before, with the description of what was calculated on the account. So if I scroll down below, we can see that there's been 3 services rendered here, an APC code service, so we're dealing with a Medicare account, and that for this first one, J code, we see that it was 200 units at an expected reimbursement amount of $600. We can see that there's 2 other services here at $52.20 and $23.76. Well, here we are again with an amount due of $600, which equals actually one of the services rendered. So this could be the specific line item that was denied. But in order to determine that, let's jump to the 835 remit data so that we can see whether that is the case. So for anyone that's looked at the 835 data, it's pretty much unreadable to the human eye. It's kind of like binary code in a lot of ways. It's a mess. Some people can do it, far smarter than myself. But what we've done is we've basically organized the 835 remit data so it's easy for anyone to analyze. Now, had there been multiple 835s, they would have been captured here. In this example, there's only one 835, and that's why we see the one here. But we're never going to double count anything on account. No matter how many times they deny the same line item or how many times they underpay the same issue, it's always going to be the true dollar owed to the organization we're counting, not every time there's an 835 that hits the system. So drilling into the 835 here, this is how we've organized the data so it's easy for the analysis. And you can see we have got the 3 services rendered on the account. The first is that J code we identified earlier. You can see that we billed out a total of $16.20, but that $16.20, the full amount, was denied when you look under the denial column. And it was the only piece of this account that was denied. Now if you scroll over to the right and look up on the notes, you can actually see the specific 835 codes that came back from on the remit. And you can see that N115 was the local coverage determination denial that actually mapped to denied services not covered. So now we know a little bit more about what's happening, but we probably want to go out and run a report to get some more details to understand specifically why did they deny it for this account. So we may have started this way in the last example, but what we're going to do is just back up and go to the report section of the tool. Now you can see here that we've got a whole lot of standard reports. We feel some best practice reports that we love our members to use, things like denial performance reports, collector performance, and our most popular report, which is our modeling comparison report. But inevitably what will happen is Providence Health System on the West Coast will say, that's nice, John, but we want to see it a little bit differently. Or UPMC will say, like your denial report, but it's missing a couple things we want to see. So we gave up and we just incorporated the ability to run, the member can run any level of custom reporting in the system. And that's under the custom report tab. So when we drill into this, it looks a lot like building a business intelligence rule, and it's really the same user-friendly kind of functionality that you had when you would build that assignment rule. So we've already preloaded this for the sake of time, but you can see that this is below the criteria we're going to focus on for this report. And what's interesting here is all of these items are coming off the 835. Because our system takes in such a broad data set, including the 835 remit data, we can report off of it. So we're looking for the EOB service line procedure of that J code, the EOB service line remark code of M115, and the payer is Medicare. Now, unlike a business intelligence rule, what we're going to do now is not tell the system what to do with the accounts, but really tell them what type of information we want to see on the report. So that's in our Options tab. So what we'd like to see is the account number, patient name, procedure code, total charges, amount due, line remark card, and attending physician. Always like to include physician when it comes to denials because that can actually key in on the trend that's causing them. Now, you can run this once on demand like we're going to do in a moment, but what I also want to call out is you can schedule reports as needed. So let's say you have a standard performance or a payer performance analysis that you're going to run every month, every week, or every quarter, or a financial report that the CFO wants to see. You can set these up, if they're never going to change, to basically run at whatever time of month or week or quarter that you would like. So that's kind of a neat feature that you don't have to reinvent the wheel every time you want to go and run a report. So let's run this report and look at the output. You can see it's the top report that came back on our completed work list here for reports. And given the size of this report, it probably would come back this fast. It's a small report, only 4 accounts. If you're dealing with very large patient populations with complex proposal changes, those may be reports that you want to run overnight, but in this example, it's going to come back fairly fast. So we can see 3 out of the 4 are actually all the same physician. And if we actually peel back the layers, this is an example that happened with one of our members. We blinded it, of course. And what was happening here is the wrong modifier is being used. So in this example, for this J-code, it's a drug for anemic patients that have a cancer diagnosis. And Medicare requires that you put an EA modifier to acknowledge their cancer diagnosis. In this instance, what we're seeing is an EC modifier inappropriately being added saying there was no cancer diagnosis. So Medicare was denying the claims. All we have to do is go back, rebuild all of these accounts with the correct EA modifier, and have an education moment with the coder, who happened to be the same coder for both physicians, to ensure it doesn't happen forevermore in the future. Now, there may be a few more of these accounts lingering in the system, and they just haven't hit yet. So what you can do from this screen is what we call create an assignment rule, or again, create that business intelligence rule, and we'll take all the criteria we use for this report, put it into the business intelligence rule. You can customize it further if you want, and then save it to automatically run in the future so that you have somewhat of an alert system acknowledging whenever another one of these accounts has been added to the project. Now, what I want to call out here before moving on is that the EOB service line reported back that the total charges were $1,620, but we didn't value this account at $1,620. We valued this at the amount due of $600. This is why it's vital to have your automated workflow tool tied to your calculation engine. Most denial management tools will value this denial at $1,620, but the reality is it's only worth $600 to the organization. Not only does this make it more difficult for financial reporting, but it may actually change the level of priority you give to certain accounts. This example had been a total charge of $200, but we were only due $20. Maybe we wouldn't have had the same level of priority to appeal this as some larger dollar amounts or more systemic trends that we were dealing with. I also want to mention that the report example we just showed can be used to run any level of detailed or summary reports. You might want to look at all of your denials across payers, or all denials to a specific payer, or all payment variances across all of your payers. You can run any type of financial or payer performance reports out of the system, and you do it in the same way we ran the specific denial variance report. So I'll pull up there and see if there's any questions from the group. So at this point, there's usually a few more questions from the member, just asking about the report aspect or denials, and then what I like to do is transition to the last example in the workflow tool before moving to modeling. So what I'd like to highlight now is the way that we calculate every single account twice, and the way that that can be powerful for eliminating all forms of revenue leakage. So we're going to use this Marcy Gates account to leverage that. So in this example, we have an amount due of $42.68. We don't know exactly why, but we do know it's an underpayment because there was no denial codes on the 835. If we scroll down below, we can see the description of how we calculated the account. Again, 3 ABC code services here, so a Medicare account. We can see that the top line was calculated expected reimbursement of $52.20, and the next two were both calculated expected reimbursement of $42.68. And if you look over to the left here, it was a bilateral left and right procedure. So for most people, the alarm bell's going off. Probably one of these left or right bilateral procedure lines was not paid, but we still don't know why. So there's a lot of ways we can start our analysis, but to illustrate the ability of how we calculate these accounts, we'll start with what we call our reconciliation or recon tab. And this is where you can capture all the different calculations on the account. So for example, we have our scrubbed claim 837 expected calculation that came back at an expected amount of $94.88. We have the charge detail expected payment calculations of $137.56. And if there's any math wizards in the room, you've already figured out that the difference between those two is the amount due of $42.68. Now the 835, all you have to do is add up these three allowable amounts below to get the total, which happens to equal the same as our scrubbed 837 claim calculation of $94.88. So the payer agrees with our third-party claim scrubber, but our charge detail doesn't. Now, in some reasons, this may be valid. Claim scrubber needs to make changes and edits so that it can go to a format that the payer can receive. But in other scenarios, maybe there's an issue with the claim scrubber that's causing us to miss revenue we should have been otherwise reimbursed for. So in order to determine if that is the case, we're actually going to move to the Claims tab to show our rendition of what the claim looks like. So again, because we take in the 837 scrubbed claim data, we can easily look at the 837 scrubbed claim sent to the payer. So if you look down below, quickly what draws my attention is that there are not three separate lines here. There's only two. And what we can see for the bilateral procedure, they combine two units at left instead of a left and a right. What this tells me is that there's an error with the third-party claim scrubber. Their clearinghouse is inappropriately applying two lines into one, and Medicare is appropriately only paying for one of them. This is actually pretty common. What's interesting is that the Cleveland Clinic was the first one that asked us to be able to calculate off the scrubbed 837 claim. To us it makes sense. It would add value to all our members because it's a more accurate source of truth for expected payment calculations. What we didn't realize is members would actually start to utilize this as an audit tool. We have an example of a small 200-bed hospital in Ohio where there was one human error of typing in the wrong rev code in the charge master, 260 versus 261, which caused them to lose over $500,000 of revenue. There's another scenario with one of our members where they inappropriately applied their government claim edits and their claim scrubber to all of their commercial payers. This cost them millions of dollars. They were able to identify it with this tool and make sure that it was billed out correctly. So this has become very powerful, not just to hold the payers accountable, but to make sure that there's no revenue leakage points at any point in the billing process. So I'll stop there and see if there's any questions from the group. So hopefully they'll kind of have a little bit of a discussion of how the accounts are calculated. Maybe there's some questions they have there, but at this point we usually addressed all of the workflow aspects. I'll usually ask one more time, were there any questions or anything you were hoping to see when it came to the revenue cycle workflow piece? Usually there's a few more questions, but we've pretty much covered everything they want in an initial meeting. So what we're going to do now is switch gears a little bit and go to the calculation engine to show you how you would model a proposal from a payer. Now, we could spend some time going through the different ways that you build a contract. That's actually the keys to the kingdom of the system that makes it so powerful. But given the broad audience we have today and the fact that that can be a whole nother 2-hour meeting, what I want to do is focus on just how we model a contract, and we can always circle back to how we build a contract at a later date, whether it's today or setting up a separate meeting. Now, just as feedback for the group watching this, the reason I do that is that there's a lot of times a lot of finance, CFO, rev cycle folks in the room. They don't really want to see how to build a contract. In other cases, if it's managed care heavy, I will actually go through it. I customize this piece of the demo based on who we're meeting with. So just to keep it simple for today, we're going to continue on with the modeling example. So in order to do that, we're going to click on Calculate a Model. And what we've done behind the scenes for the sake of time is we've taken a current contract, let's say United's current contract in the system. We've copied it forward and made whatever small tweaks and changes that United has proposed. This can be anywhere from a 10 to 30-minute exercise depending on the amount of changes United is proposing. And then you save it as a model. So we've already copied the current contract, we've made the changes, and now we've saved it as a proposal, and that's where we're going to start this example. So there's a few decisions you have to make when you're calculating a proposal. The first is, are we going to calculate this on the charge detail amount, the scrubbed 837 claim, or both? And I'll tell you, best practice for a lot of our members is that they'll run it once on charge detail and then again on the scrubbed 837 claim and allow them to compare the delta on a higher level between the two to identify any of the claim scrubber issues that we went through in the former example. The next decision we need to make is what model rate schedule we're going to analyze. So that proposal we just copied forward, or rather the contract we just copied forward and saved as a proposal, we now need to select that. So in this example, it's actually, again, something that happened with one of our members, so we've blinded it, and we're going to call it Payer A Plan B Proposal for 2014. Obviously, the dates are old because this is a historical example of one of our members, so that's why you're going to see 2014 and 2013. Now, the next decision we need to make is, are we going to leverage a charge master adjustment in conjunction with this proposal analysis? We feel it's vital to take in any changes of your charge master while making a proposal analysis, because if we don't change the charge master, we're not looking at a true apples-to-apples comparison. So, for example, you have total flexibility here. You can make wide sweeping changes like 10% outpatient, 5% inpatient, or you can do things down to the specific department level or code level. But what we advocate is if you have your charge master for next year, you simply upload that charge master for 2014 in this example so that you can compare the real-world charge master adjustments if you have that available. The next decision we need to make is, what patient population are we going to select? Again, the theme here is total flexibility. You can decide to create any patient population that you want. You're not limited here. So you can say, I want to create just an open heart surgery population, or I just want to look at Medicare, or I want to look at all of my patients across the entire health system. In this example, we're going to keep it specific to this payer, so we created a Payer A Plan B population to compare to the Payer A Plan B proposal. And then finally, one of the great new features we've added, I'd say about 18 months ago, was the ability to map the net impact to DRG version changes. We have a lot of organizations that are shifting to APR-DRG or EAPG coding, or maybe just a different version of the MS-DRG. That can be somewhat complicated even if they have the groupings supplied to them to actually calculate the financial impact of those DRG version changes. So instead of relying on back-of-the-envelope math, we've given the ability to automate that as part of your overall proposal analysis. So you'd simply click Calculate Now after making these decisions, and we're going to jump back to the report section of the tool to actually look at the output. So, as I mentioned before, our most popular standard report is our modeling calculation report. That's the report we're going to leverage now. And the first thing we need to do is choose the patient population we're going to analyze. So we're using Payer A Plan B population. And once we do that, now available in all the drop-downs below are all the proposals or current contracts that we've run against this population. So in this example, we're going to start with the proposal for 2014 against the current 2013 rates. We submit that and look at the output. So, as you can see here, it starts with high-level executive summary information on the overall proposal analysis. Always want to make sure certain things are consistent. For example, your account totals, your total days, total charges, those should all be the same. But the fun part is looking at the total expected difference, which is the fourth bucket down. And you can see if you scroll over to the right to the difference column, we're expecting nearly a $500,000 increase proposed by the payer. That's great. It's going in the right direction. But if you look at the net yield down below, it's under 0.5% increase. Maybe we were expecting more. And more than that, we really don't trust the payers just to hand us more money. Maybe they're expecting more patient responsibility to be shifted. Maybe they think we're going to be doing less or more of a certain type of procedure. I doubt they're just willing to hand us over additional dollars next year. So we want to dive a little bit deeper in what's driving the difference here. So this was an inpatient-only example. Had it been outpatient, the summary information would have been captured here below. And as we continue to scroll down, we've got all the different service lines that actually make up this agreement. So we've got our cardiovascular procedure with stents, and we calculated at a case rate. We've got implants calculated at percent bill charge. We've got our ICU at per diem, and so on and so on. And if you scroll over to the right, you can look again at the expected difference column to see where are we getting a lift, where are we getting a decrease. So you can see on the top here we've got roughly $45,000 that we're losing for cardiovascular procedure with stents. We've got a few other areas where we're either seeing an increase, a slight decrease, or neutral. So let's focus our analysis on this particular procedure. Again, all of these are hyperlinked so we can start to drill deeper and deeper. So we're now looking at the 74 accounts that make up cardiovascular procedure with stents. It's a high-level executive summary information like we started with and to begin with. And then below are all of the individual accounts that make up this patient population. So you can see all 74 accounts captured here. And if we look at the expected difference column as we scroll down on all the accounts, they're proposing, or rather the payer's proposing, a $600 rate decrease across the board. Now maybe something sticks out to you. There's a particular outlier with one of these accounts, something doesn't feel right. So you can drill down into the individual account to continue your analysis. So now we're looking at Zachary Webb. This is his particular account. You can see that there's 2 services rendered once you scroll past the summary information to cardiovascular procedure with stent and the implants used. So you can see that we're losing $600 on the cardiovascular procedure itself, but we're actually gaining over $300 on the implants. So we're not losing a total of $600 on the account. Now the numbers in this example actually don't matter that much. What's important is that we empower our members to get down to any level of details they need to determine whether they're optimizing their future payer margins with this type of a proposal. This is vital in leveling the playing field with the payer. They have this level of sophistication and analysis, and we want to make sure our members have it too. So I'll stop there for a moment and see if there's any questions on how we would model a contract. So at that point, we're going to go through whatever questions they have. There's usually a lot of questions both in the modeling workflow world that people are jumping out with. Sometimes they're going through what the implementation timelines look like, the resources needed to man the tool or staff it, results from members, how we worked with particular institutions in the area, types of source systems. It kind of runs the full gambit of questions, as you can imagine. But what I want to do is transition a little bit to what I would do in general in the next phase as we leave the demo. So the first thing I'm going to do is pull back up and I'm going to ask another clarifying question. Were there any thoughts overall on the demo we went through, any aspect of the functionality, not just the modeling portion? Again, it fosters a discussion if I don't feel like we've gotten there naturally. The second thing I do is I usually go to the next question. So I'd love to get a sense from the room what your initial thoughts are on the value of this technology. I saw a lot of head nods from here to there. It sounds like there's value in the level of automation. It sounds like we've got more details for modeling, but I'd love to hear from you where you think this could be valuable for your organization. That's an important question because you don't want to assume that they're impressed. You don't want to assume they've attached value to certain aspects of the tool. They'll actually tell you where they think the ROI is, so it's important to ask that question, pull up, and kind of listen to their response. So hopefully they validated that you've done a great job in the meeting and that they love Payment Integrity Compass. And at that point, you want to start to describe a few more aspects of the partnership. One of the most important ways that we separate ourselves from any other vendor in this space is our partnership model, the dedicated advisor. So what I like to do is kind of explain that next. So we focus a lot on the solution itself, and it's great to hear that you feel there's a lot of value on the functionality. But as I mentioned before, we don't think it's just technology. We really feel this is a partnership. So as you've seen with some of your other memberships in the revenue cycle world or with Crimson, you actually would have the same model set up here, but a little bit more hands-on. What I mean by that is you would have a dedicated advisor, and as you may have known with past engagements, your dedicated advisor is really your expert liaison between your organization and the solution itself. They're your quarterback to make sure that everything is going right with the technology. If there's any issues with the solution itself, they'll be there to help make sure they get resolved quickly. But also they want to focus not just on making sure it's working, but making sure you're maximizing the value. They'll look for additional areas if we don't think we're maximizing the tool. They'll try to continue the support and training process to make sure we're running at full cylinders. So they're there to really make sure that you're getting as much value out of the system as possible. They're supported with contract analysts who actually help the managed care teams build the contracts, model them, and even with negotiation support. And also business analysts who are there to make sure that the data feeds are running through appropriately and we have all the data we need to populate the tool. So any questions on the overall partnership model? Great. Well, the next thing I wanted to share with you is the 4 key things that we focus on when thinking about new members. So as we talked about earlier, you definitely see some of the value here. What I wanted to share was a few things that we look at as far as next steps, and especially with cost. Would that be appropriate to go there now? I always want to acknowledge that if there's a senior executive in the room or CFO, sometimes they want to have that conversation offline. Sometimes I don't want to assume I've earned that right. I really want to get acknowledgement that they're eager to hear what the price is and maybe talk about next steps. So when I transition, I say there's really 4 key things that we look for new members. The first is there a strong business case? And what I mean by that is there value to the organization? What we've seen is the most successful members that we have are the ones that are most committed. We truly look at this as a partnership. That's first and foremost. I can tell you from our discussion today, there definitely seems like a lot of value, a tremendous amount of value here, but I know that this is the first discussion. I'm sure you'll need to huddle up as a team, and we can have that more in-depth discussion on the value on our follow-up call next week. The second piece is IT feasibility. So we really want to ensure with any member that we can fully support them from the data standpoint to make sure the partnership is successful. There's no concerns I have given our familiarity with your health system and the type of systems that you're currently on, but we would want to set up probably a 30-minute IT feasibility call just to ensure that we can fully support the partnership. And the next thing is really what the enrollment fees look like. And so similar to the other advisory board memberships you have, they're broken down into two categories. There is a one-time implementation fee to fully support and build and customize the solution itself for X amount. And there's the ongoing annual service fee that includes the ongoing support with the partnership as well as enhancements and obviously the ongoing use of the technology itself, and that would be X as well. So those are the two fees that are associated with the partnership. I do want to stop there before moving on to the fourth item to see if there's any questions on the fees. I usually want to dig in deeper with the member here, get their reaction, address any concerns. If there's major concerns, what I usually do is bring it back to the value of the product. So one of the things I like to say is, if you could strip any budget concerns out of the way, and this was something that you had access to, do you feel that this adds value to the organization? Because that's what's most important to us. Hopefully there's an acknowledgement that if fees weren't an issue, 100% they would want to move forward with the value. Great. Well, I actually think there's a strong ROI case to be made. And one of the follow-up items I want to take away from today is running a very conservative, almost worst-case ROI that I can share with you on our follow-up call next week to really put into reference or make the fees a little bit more relevant versus just thinking about a big fee amount. So we'll go through the conservative ROI, and I think that will make this a lot more realistic, and you really see that the fees are a lot more feasible. Does that sound like a good next step? Hopefully say yes. So the next piece is sometimes I'll address, if it's a really kind of jaw-dropping moment on the fees, is what we have a partner that actually does a historical revenue review. So one way that we've been able to justify the full cost of the partnership is we have a partner that can go through and do a 2-year historical review of all of your closed accounts. These are accounts you would not be collecting on, but we think because you probably, due to bandwidth issues, may have written off some revenue, there's still opportunity there. They'll go through for a contingency fee, find any revenue that was missed, and those can justify actually the full cost of the partnership. So I'm always happy to explore that option as well as a huge value-add piece. We can have a discussion on that. So now that we've addressed the pricing and the 3 important aspects of taking on a new member, there is the fourth piece that I wanted to talk about, and that's really the timing of a decision. Given the scale of this partnership, it's really important to us to know who we're going to be working with and when we'll start working with them. So one area that I can influence flexibility on any part of the scope of partnership or even the pricing is knowing how long we'll be working with a member and when we'll make that decision. So for example, if you're able to make a decision before the end of June, that would be beneficial for us. It's a premium to have that forward visibility. I can definitely be flexible on pricing. So one thing I was hoping to learn from today is, do you think end of June would be realistic to kind of come to a yay or nay on moving forward with the partnership? Allow them to answer, kind of go through whether that's realistic or not, and then obviously you can kind of set expectations from there. There'll be scenarios where they say, oh no, June is not realistic at all. The way I simply address that is saying, that's fine, it's our initial discussion today. Why don't we go back to our first step of the follow-up call next week? We'll go through the ROI. We'll kind of establish a timeline for the evaluations, and we'll see where we fall out. If there's something we can do before end of June, great. If not, that's fine too. We'll just kind of set our expectations as we move through the process. If they're able to make end of June, that's great. I think you have earned the right then to be a little bit aggressive about the next steps you want to do. So a lot of times they'll request references. You may be proactive there in setting that up. The IT feasibility call, there are probably additional web demos. Sometimes people didn't attend the meeting. They want to see a deep dive in a particular area of the tool. I would try to establish what their needs are so you can start working on those right away. At that point, we've come to an agreement on the next step of the follow-up call, running the ROI, putting kind of the pricing together for them as part of that ROI analysis, and maybe some other next steps that we just discussed. So at that point, I usually pull up and say, well, are there any other questions or anything else we need to address before we end our time together? Hopefully, we've taken care of everything, and at that point, I usually just thank them for their time and end the meeting. So that's really everything I wanted to go through today, so I hope that was helpful, and thank you for your time.